Welcome to Delphos Insights. This is episode 37, where we examine emerging markets capital flows in 2026, the three structural shifts reshaping allocation, and what investors require. So we're basically doing a deep dive into the actual physical plumbing of global capital today.
Right, because if you're trying to navigate emerging markets right now, you really can't just look at traditional yield anymore. I mean, you have to look at how the physical world is being completely rebuilt.
Exactly. We are unpacking three durable structural shifts that are permanently rewiring where institutional money goes for the first half of 2026. Let's jump right into the first shift, trade fragmentation.
Yeah, the tariff environment is completely forcing this.
Right, with the U.S. effective tariff rate hitting 7.1% and China facing 25%, we're seeing this massive acceleration in nearshoring.
Absolutely. And as a result, we're seeing infrastructure capital aggressively redirect toward logistics, hubs, ports, manufacturing corridors. We are talking about places like Mexico, India, select African markets, and, especially ASEAN.
Yeah, the Association of Southeast Asian Nations.
Exactly. I mean, just to put a scale on this, foreign direct investment into the ASEAN region alone recently reached $226 billion US.
226 billion. But wait, let me push back here for a second. Are we absolutely sure this is a permanent structural shift? Because, well, it feels like it could just be a temporary cyclical reaction to trade tensions. Eventually, things cool down, right?
It's a fair question, and a lot of investors initially thought the exact same thing. But here's why it's durable. Corporations aren't just hedging against temporary shipping delays anymore. They are entirely rebuilding their procurement networks.
Because you don't spend billions of dollars building a new deep-water port or cross-border rail line if you plan to just abandon it in 2 years.
Right. And that massive physical infrastructure requires long-term commercial debt and, heavy backing from DFIs. Which actually brings us to our second structural shift.
Right. AI and real assets.
Yeah.
Because building physical trade routes requires physical pipes, but digital expansion requires immense physical power.
Lots of it. You cannot run a localized AI hub without electricity. Right now, global data center investment is sitting at $270 billion US.
Which completely flips the script on how we view the sector. I mean, AI isn't really a technology story anymore, is it? It's fundamentally an energy story.
Precisely. The computational demand has just completely crossed into supercycle territory. Power availability and grid capacity are the absolute major bottlenecks right now.
So what do institutional investors do?
They rotate heavily into long-duration real assets just to capture that demand. We are looking at global electricity investment expected to hit $1.5 trillion US.
Okay, so if we connect this to the bigger picture, we need physical infrastructure for trade, we need data centers for AI, and we need an unfathomable amount of energy to power those grids, which directly moves our narrative to the raw materials required to build all of that.
Exactly. And that brings us to the third shift, geopolitics as a permanent pricing variable. Historically, markets treated geopolitical risk as an event risk.
Like a war breaks out, a supply chain snaps, and you reprice the deal after the fact.
Right. But today, geopolitics is baked into the math from day one. Take critical minerals, for example. Because China controls 98% of the production for LFP cathodes.
Wow, 98%.
Yeah, 98%. And those are the specific chemical components needed for grid storage batteries. So Western capital now looks at a standard critical minerals project in Brazil or Zambia totally differently.
It's no longer just a generic mining project. It's a strategic asset essential for securing supply chains.
Exactly. And because it's a strategic asset, it easily attracts DFI co-investment, concessional capital, and blended finance structures.
So what does this all mean for you, the listener? It means the emerging markets universe is distinctly bifurcating. If you have a strategic asset, capital flows.
But on the flip side, if you're in a generic frontier market, you are facing intense selectivity. You're dealing with elevated sovereign spreads and highly stringent debt service coverage ratios. Banks want absolute proof you can survive under stress.
Which brings up a critical strategic question. If you are an issuer preparing a capital raise for the second half of 2026, you're stepping into this highly selective market.
Yeah.
In this bifurcated environment, how exactly do sponsors prove bankability, structure governance, accurately price risk, and ensure absolute investment committee readiness before they ever approach investors?
It's the most important thing to solve right now. You have to lock down political risk insurance and present a bulletproof capital structure immediately. Generic narratives simply will not survive the pitch room anymore.
Which leaves you with a final thought to mull over. If institutional capital allocation is increasingly dictated by geopolitical security and supply chain resilience rather than pure yield, are we entering an era where a country's political alignment actually matters more to an asset's valuation than its traditional financial fundamentals?
It's a massive paradigm shift for the industry.
It really is. This has been Delphos Insights. Learn more at delphos.co.